Wall Street's biggest secret weapon? It used to be exclusive data and elite teams of analysts. But today, your biggest advantage might already be in your pocket. Retail investors, once mocked for chasing meme stocks, are now using AI tools so powerful they're making trades faster than some hedge funds. In just 1 week, individual investors poured more money into a tiny quantum computing firm than they did into United Health, a $275 billion giant. Think it's just hype? AI isn't just catching up, it's reshaping the game, flipping the script on who has the edge. But here's the twist. Most AI-powered ETFs are still underperforming. So what's really happening behind the curtain? If you're using AI, or thinking about using it to invest, you need to know what no one else is telling you. Watch until the end. We uncover the real risks of AI trading, the new behavioral traps, and how retail investors might be walking straight into the next crash without even realizing it. This isn't just another AI hype story. It's the new frontier of market power, and you'll want to be on the right side of it. Hit play, watch now, before the next trade makes you obsolete.
To keep you hooked. Today, we're plunging into one of the most compelling shifts happening in global markets: how artificial intelligence is radically reshaping the investment landscape for individual investors. For years, it felt like Wall Street held all the cards, but is AI finally leveling that playing field? We're going to uncover how AI is empowering the everyday investor, the dramatic shifts in what the crowd is buying, and whether these new tools are truly translating into better performance. Get ready for some insights that will fundamentally reshape how you view power in today's markets. So, for years, it's been a truism in finance. The individual investor, often outgunned, always playing catch-up against the massive resources of Wall Street. Have you ever felt like you're navigating the market with a map from a different era while the pros have satellite navigation?
Oh, absolutely. It's a feeling rooted in reality, not just perception. Historically, individual retail investors have consistently underperformed institutional investors. And even basic market benchmarks. Look at 2023, for example. The average retail equity fund investor lagged the S&P 500 by a significant 5.5%. That's quite a gap.
5.5%? Wow, why such a big difference?
Well, a large part of this underperformance stems from common behavioral mistakes, buying into peaks and selling into troughs, classic errors, and also a stark lack of access to the sophisticated research, the real-time data, the insights that big firms just take for granted.
Right, the information edge they always had.
Exactly. However, it's really vital to recognize that individual investors are far from negligible. They're a huge force. They directly own roughly 25% of the U.S. stock market and over 60% indirectly through things like retirement accounts.
So they have weight, even if they haven't always punched at that weight effectively.
Precisely. And we've seen their collective influence in dramatic moments, like the 2021 meme stock rallies. Retail traders showed they absolutely can move markets, even if those weren't always, let's say, profitable ventures for everyone involved in the long run.
Okay, so we've talked about that historical disadvantage, but you said something truly transformative is underway now. How exactly are these sophisticated AI tools, which once felt so exclusive to Wall Street, now finding their way into the hands of individual investors?
Yeah, this is where it gets really interesting. What's truly fascinating here is the rapid democratization of these cutting-edge AI tools. It's not just about getting more data. It's about democratizing the cognitive capacity needed to actually process that data effectively.
Cognitive capacity, like having an analyst brain on demand.
Sort of, yeah.
Yeah.
Take Robinhood's Cortex, for instance, announced just this past March. It's designed to summarize all the variables affecting a stock's price, condensing complex information, simplifying strategies like options trading even, or look at Interactive Broker's Reflexivity. It's an AI-driven platform that monitors huge data streams, provides tailored insights, like how interest rate shifts might impact your specific portfolio.
Tailored insights, not just generic reports.
Exactly. And these aren't just small improvements. These tools allow a solo investor to react to market shifts virtually as fast as, sophisticated quantitative hedge funds. It's almost like getting an entire team of analysts instantly right at your fingertips.
That sounds incredibly powerful.
Well,
Almost too good to be true. If it's truly like getting a team of analysts, maybe even for free or cheap, what are the limitations or the pitfalls? Does it really dismantle that information asymmetry that's defined markets for so long?
That's a really essential question. And yes, I think AI is shattering the information asymmetry that used to be such a defining barrier. David Lin, former managing director at JP Morgan, put it quite well. He said, information at your fingertips is much cheaper now.
Cheaper and faster.
Right. Think about it. Top-tier research, real-time news feeds, complex data analysis. That used to be incredibly costly, exclusive. Now, much of it is inexpensive or even free. And the psychological shift is profound.
How so?
Well, surveys show 41% of investors say they would invest more if they had an AI chatbot assistant. And get this, about half of global retail investors now feel they are not disadvantaged compared to institutional investors.
Half. That's a massive change in sentiment.
It really is. And it's driven directly by this cost efficiency. Companies like DeepFake, an AI model developer, are pushing down the price of these analytical tools. It makes powerful AI accessible to almost anyone. Platforms like David Lin's own Linvest21.ai are examples of this trend, aiming for broad accessibility.
Okay, so AI is leveling the playing field on the information front, making powerful tools cheaper, faster, more accessible. Are we seeing that translate into actual changes in how individuals are investing? What does their portfolio behavior look like now?
Yes, we're seeing concrete evidence of a significant behavioral shift. It's not just theory. Retail investors aren't just getting smarter tools. They seem to be acting differently, moving beyond simply chasing the most obvious hot stocks.
Like the big tech names everyone talks about.
Exactly. JP Morgan data shows that retail traders' concentration in the Magnificent Seven mega-cap tech stocks, well, it was about 10% last summer, right? By June 2025, it had dropped to nearly 1%.
10% down to 1%. That's a huge diversification away from those giants.
It's a striking move. It indicates a much broader, more diversified approach. And instead, we're seeing retail money actively piling into new AI frontiers, specifically smaller data center stocks.
Smaller data centers, like who?
Companies like Applied Digital, Navitas Semiconductor, CoreWeave, many affiliated with NVIDIA in some way. This suggests they're using these new AI tools to perhaps identify emerging high-growth areas beyond the well-trodden paths of the megacaps.
So they're not just diversifying out of the Mag 7, but maybe concentrating into these new, possibly riskier AI-related areas. Is there a danger they're just swapping one form of concentration risk for another, maybe one that's even less understood just because an AI pointed them there?
That's a very perceptive point, and it absolutely highlights an increased risk appetite. It's not all just smart diversification. We've seen vivid, almost staggering examples of this shift.
Like what?
Well, in one single week in May, retail investors actually bought more shares of a tiny small-cap quantum computing firm called D-Wave Quantum. It's like a $6 billion market cap company. They bought more of that than of a $275 billion blue chip like United Health Group.
More money into D-Wave than United Health in a week from retail.
Yeah. And they funneled $25 million into another tiny AI stock, Rigetti Computing, compared to only $17 million into Meta, Facebook.
Wow. So they're definitely making bigger bets on smaller, more speculative names.
It does seem that way. It's almost a modern echo of past market frenzies, perhaps. The tools are new, the tech is different, but maybe that human tendency to chase explosive gains, especially when presented with a hot new frontier like AI, is still very much there, turbocharged by AI tools, perhaps.
And that can lead to big wins, but also big losses.
Right, absolutely. Well, these kinds of plays can yield explosive gains, and we saw some of that with AI, quantum, semiconductor, penny stocks in 2023, 2024. It also exposes them to much, much higher volatility. Analysts have even noted it shows a level of complacency sometimes.
Complacency, meaning they might be underestimating the risks.
Potentially. A feeling that maybe after a good run, the risk isn't as high, even with lingering macro concerns out there. Still, the market impact of this retail activity is undeniable. Individual investor buying was a significant factor behind the S&P 500's, 21% surge in the first part of 2025. And retail sentiment, measured by Barclays' Equity Euphoria Index, has definitely been on the rise.
Okay, so more sophisticated tools, more diversification away from megacaps, but also maybe bigger bets on riskier niches. What does this all mean for actual returns? Are retail investors armed with AI finally beating the pros? Or is this just hype that eventually evens out? Does AI truly address the human element of investing, the emotion, the discipline, or just the analytical side?
Yeah, the results are, well, it's a very balanced picture, and the human element remains absolutely paramount. On one hand, there's promising research. A May 2024 University of Chicago working paper found that ChatGPT-based analysis could yield higher cumulative returns over time.
How?
By uncovering value in smaller, underfollowed stocks, places where maybe human analysts haven't focused as much.
Yeah.
So AI can genuinely help identify overlooked opportunities.
Okay, so some academic support for the idea. What about in practice, like with AI-managed funds?
That's where it gets more mixed.
Yeah.
When we look at AI-managed ETFs, the results are still forming and, frankly, often underwhelming so far. You have things like Intelligent Alpha's LEVR ETF, which uses large language models trying to emulate legendary investors.
Cool concept. Sounds cool. Does it work?
Well, in 2024, out of 16 AI-focused ETFs tracked by Bloomberg Intelligence, only one Franklin's AI ETF actually managed to beat the S&P 500, and just barely, 19% versus the index's 18%. Most haven't consistently outperformed.
Only 1 out of 16 beat the index. Why is that, if the AI is so powerful?
It could be several things. AI models, while powerful, often struggle with truly real-time market data interpretation. Remember, their training data is always historical by definition. They also might have difficulties capturing the nuanced human sentiment that drives market psychology or predicting genuine black swan events, things outside the training data.
So AI isn't a crystal ball.
Definitely not. It certainly doesn't eliminate those behavioral pitfalls or market risks we talked about. And while retail investors definitely benefited from the 2023 tech rally, their current venture into these riskier corners of the market, it does suggest, as we said, a potential complacency mismatched with lingering macro risks. The AI might find an idea, but managing the risk is still human.
Right. And it's easy to get excited about the individual games and this newfound power, but we can't forget the institutions. They aren't just sitting idle, are they? What are they doing with AI? If AI is becoming, like, table stakes for the retail investor, where does the new edge, the new alpha for the professionals come from?
You're absolutely right. They are definitely not sitting still. Institutional adoption of AI is widespread and deepening rapidly. Get this. More than 50% of new algorithmic trading patents now include AI. That's up hugely from just 19% back in 2017.
Wow, half of new algo patents. What are they using it for?
Everything. From deep sentiment analysis of, say, central bank statements trying to read between the lines, to ultra-high-frequency trading that processes market data in milliseconds, looking for tiny arbitrage opportunities.
So they're doubling down on AI, too. Are they getting better results?
It's still a mixed bag there, too, honestly. While some specific AI hedge funds, like the famous Renaissance Technologies, have undeniably impressive long-term records, the overall industry results for active funds using AI are still quite varied. Many still underperform the S&P 500 in 2023, for instance.
So even for the pros, AI isn't a magic bullet either.
Not automatically, no. What's clear is that the bar for alpha is rising, as they say. AI tools are becoming the new normal. Just having access isn't enough to guarantee outperformance anymore. The new edge will likely come from how innovatively you apply these tools, how you integrate them with human insight, and crucially, how you manage the new risks they introduce.
And with so many players, both retail and institutional, maybe using similar AI models, that has to create new systemic risks for the entire market, right? Could we be heading towards some kind of AI-fueled synchronized trading that just amplifies volatility, like everyone running for the exit at the same time because the AI said so?
Indeed, that's a significant concern. It's being highlighted by regulators like FINRA and the SEC, and even the IMF. There's a real worry about herding behavior. If too many market participants, big or small, rely on similar AI models, using similar data inputs or logic.
They all reach the same conclusion at the same time.
Exactly. It could lead to highly correlated trades. This could absolutely exaggerate volatility, especially in a crisis. You could see cascading sell-offs as everyone's AI models flag the same sell signals and execute similar decisions almost simultaneously.
Scary thought.
Yeah.
Are there other new risks, too?
Yeah, there's also the persistent risk of AI-driven scams or misinformation. Imagine sophisticated deepfakes or AI-generated news articles designed specifically to manipulate stock prices, especially targeting less experienced investors who might, blindly trust an AI output without critical assessment. It's a whole new frontier of market integrity challenges.
Okay, so it's a complex picture. When we talk to the top minds in finance, the experts looking at this, what's their overall take? Is the individual investor truly becoming the new Wall Street, or is it a more nuanced evolution? What does this mean for the fundamental nature of trying to outperform the market?
The consensus is definitely nuanced. It points towards a significant leveling of the playing field, yes, but not an outright reversal of the old hierarchies. Not yet, anyway. There's considerable optimism about retail's new edge. You hear people like Jan Szilagyi, CEO of Reflexivity AI, saying AI offers 100 times difference in what a tech-savvy investor can achieve now.
100 times. That's a bold claim.
It is. And Alexander Altman from Barclays notes, AI's ability to help people code and analyze data without needing a deep technical background really empowers retail traders. David Lin even envisions individuals potentially running their own small hedge fund without much staff because AI can do so much of the heavy analytical lifting.
Running your own hedge fund from your laptop.
That's the vision some people have. However, there's also significant caution, a dose of reality from others. Ken Griffin of Citadel, obviously a giant in the hedge fund world, acknowledges that data and tech make markets more competitive, but he stresses that scale and skill still matter immensely in consistently beating the market.
Scale and skill. The old advantages haven't vanished.
Not entirely. And Marco Uccini of Vanda Research, who tracks retail flows closely, observes that retail investors are growing more sophisticated with this tech. But he also points out they're often using that newfound sophistication for bigger gambles.
So the tools are better, but maybe the discipline isn't always keeping pace.
That seems to be the crux of it. While AI provides unprecedented access to information and analytical power, those human elements, skill, discipline, risk management, they aren't made obsolete. In fact, they might be even more important now. Skill now means understanding how to prompt the AI effectively, how to critically interpret its outputs, how to blend its insights with your own judgment and experience.
Right, not just taking the AI's word for it.
Exactly. Discipline means not letting the ease of AI-driven analysis lead you into overtrading or chasing every fleeting signal it generates. And risk management becomes even more critical when AI can, with deceptive ease, lead you into highly concentrated or volatile positions that maybe you don't fully understand.
So the playing field is more level, but it's still a challenging game.
I think that's the right way to put it. Most experts agree AI is narrowing the gap, definitely. The access to tools and data is much more level. But consistently outperforming the pros still requires those fundamental human strengths, now just powerfully augmented or potentially dangerously enabled by AI.
So you've heard it here. The world of investing is undeniably shifting. AI is empowering individual investors in ways we really couldn't have imagined just a few years ago. We're seeing more data-driven decisions. We're seeing changes in diversification, even some stunning successes in uncovering overlooked opportunities. It's truly a compelling new era for markets.
It absolutely is. But while the playing field is undoubtedly more level, this is far from a complete overhaul. The professionals are evolving too, adapting their own strategies. And as we discussed, new AI-driven risks are emerging for everyone involved. So the question really isn't whether AI can help you anymore. It clearly can. The real question is how you choose to use it, and whether that usage includes the discipline to manage new levels of risk and to critically assess the insights AI provides rather than just following blindly.
And that leaves us with a pretty provocative thought for you to consider. As AI continues to embed itself deeper and deeper into the fabric of financial markets, will outperformance become less about who has the biggest building or the most resources, and more about who wields the best analytical judgment, the best synthesis of human and machine intelligence, regardless of their institutional affiliation? What will you do with these new capabilities?
That's a wrap for today. If this episode gave you a new perspective or made you rethink how AI is changing the game, you're not alone. So, help someone else stay ahead. Share this episode, like it to show it matters, and subscribe so you don't miss what's coming next. Because the next shift in markets, AI, or strategy might just be hiding in the next episode. Thanks for watching. Stay curious and stay ahead.